1929, 1973, 2000, 2008, 2020. Each of these years marks a point where human confidence collided with systemic fragility, producing economic collapse that reshaped generations. Different headlines, different technologies, different policies, yet the underlying pattern remains identical. Human psychology, leverage, speculation, and structural imbalances combine to create inevitable financial crises. Every generation believes it has learned from the past, yet every generation faces its own crash, often more severe than the last. History is not a series of anomalies but a repeating pattern. Memory fades, optimism rises, risk accumulates, and the cycle begins anew. The roots of these crises are universal. At the center lies human behavior. Optimism drives innovation and growth, but overconfidence produces blind spots. Memory decay ensures that the lessons of prior crises are forgotten. Each generation interprets prior events as anomalies rather than structural warnings. Leverage amplifies the consequences of misjudgment. Credit expands when confidence is high and contracts when panic arrives. Speculation detaches asset prices from underlying fundamentals. External shocks, whether technological, geopolitical, or environmental, serve as triggers, turning latent fragility into visible collapse. The sequence is predictable: optimism, overconfidence, leverage, speculation, shock, panic, systemic correction, and eventual amnesia. The 1920s provide the first modern example of this cycle. America emerged from World War I with newfound wealth, industrial growth, and technological optimism. Wall Street surged, speculative investments multiplied, and margin trading became common. Ordinary Americans borrowed to invest in stocks, assuming prices would rise indefinitely. Banks operated on the assumption that prosperity was permanent. Regulators trusted the invisible hand. Analysts predicted endless growth. Confidence became overconfidence. By October 1929, the market faltered. Margin calls forced liquidation, panicked investors sold in droves, and banks failed. The crash wiped out entire fortunes and triggered the Great Depression, a global contraction lasting a decade. The lesson was clear. Speculation combined with leverage is dangerous. The 1970s demonstrated a different form of economic fragility. The post-war boom had created a sense of linear growth. Governments and corporations assumed stability would persist. Then the oil shocks arrived. OPEC's embargoes and price manipulations caused inflation to surge while growth slowed. Stagflation emerged. Policymakers attempted fiscal interventions, but the system responded slowly. Wealth eroded quietly. Confidence deteriorated incrementally. Unlike 1929, this crisis was gradual, revealing that systemic risk can build slowly and external shocks can amplify latent weaknesses. The 2000s introduced another pattern with the dot-com bubble. Technology promised transformation, efficiency, and wealth. Investors, captivated by potential, bid valuations to irrational heights. Many companies had no revenue, only projections. IPOs were celebrated regardless of profitability, margin trading returned, speculation detached valuations from fundamentals. In 2000, the Nasdaq collapsed, wiping out trillions in market value. This crisis demonstrated that even revolutionary innovation cannot prevent the repetition of financial excess. By 2008, the system had become more complex. Housing prices had risen continuously. Banks created sophisticated instruments, mortgage-backed securities, and credit default swaps. Regulators underestimated systemic risk. Investors assumed diversification equaled safety. Leverage extended beyond banks into shadow banking systems. When the housing market faltered, the interconnected financial network became unstable. Lehman Brothers collapsed, credit froze, markets plummeted. Unlike prior crises, 2008 exposed global interconnectivity. Contagion spread rapidly across borders, sectors, and asset classes. Complexity masked fragility, but fragility remained. The 2020 pandemic illustrated that crises are not always driven solely by overconfidence. COVID-19 produced a sudden halt in global economic activity. Central banks intervened with speed, printing money and issuing massive stimulus. Economies stabilized temporarily, but interventions expanded debt and increased moral hazard. Asset prices detached from productivity. Markets appeared resilient but became increasingly fragile. Structural vulnerabilities accumulated beneath the surface. Examining the mechanics reveals repeating patterns. Innovation introduces optimism. Human overconfidence interprets this as permanence. Credit expands. Leverage accumulates. Asset prices decouple from reality. A trigger event exposes fragility. Confidence collapses. Systemic impacts cascade through banks, corporations, and governments. Modern financial systems magnify risk. Global interconnectivity accelerates contagion. Bond markets are larger than equity markets and influence sovereign financing. Corporate leverage has reached historically high levels. Companies refinanced at low rates, often using capital for buybacks or speculative expansion. Rate normalization threatens solvency. Private credit markets, opaque and heavily leveraged, amplify risk. Redemption pressures can force asset sales, destabilizing valuations. Currency markets introduce additional complexity. The US dollar remains the primary reserve currency, but confidence is critical. Rising sovereign debt can erode trust. Emerging markets are particularly exposed. Capital outflows and currency depreciation trigger interventions. Interconnected markets transmit shocks instantly, leaving little time for adjustment. Geopolitical tensions exacerbate vulnerability. Energy supply disruptions, trade disputes, and sanctions can amplify economic fragility. Coordination is less predictable. Energy shocks can simultaneously impact production and sovereign balance sheets. Global interdependence ensures that localized disruption propagates rapidly, magnifying consequences. Demographics also create structural pressure. Aging populations in major economies increase social security obligations while reducing the working age population. Productivity growth must compensate but often lags. Debt servicing and pension obligations become strained. Social and political instability rises as fiscal gaps widen. Behavioral economics explains why these cycles persist. Humans are overconfident in favorable periods and overly risk-averse in downturns. Memory decay ensures that each generation underestimates potential losses. Herd behavior amplifies both booms and busts. Optimism blinds markets to fragility. Even with historical knowledge, perception shapes behavior. Confidence, a psychological construct, drives markets as much as fundamental reality. Debt accumulation across generations increases systemic risk. Households, corporations, and governments borrow to support consumption or stabilization. Debt is manageable when expectations align with reality but becomes vulnerable when growth falters. Each cycle compounds systemic fragility, leaving more to correct. Modern crises emerge in unexpected locations. Shadow banking, private credit, and leveraged derivatives can all serve as catalysts. Triggers may be minor but propagate. Policy interventions can delay but not prevent correction. Rate cuts and stimulus temporarily stabilize markets but increase leverage and moral hazard. Technological acceleration affects crisis dynamics. High-frequency trading and algorithmic arbitrage propagate market reactions instantly, amplifying volatility. Automated systems amplify volatility. Human decision-making lags, unable to counter rapid feedback loops. Market corrections occur faster than comprehension. Education and awareness can mitigate consequences but cannot eliminate them. Understanding historical patterns informs preparation, but structural vulnerabilities persist. The inevitability of crises is a feature of systemic dynamics and human behavior, not of ignorance alone. Historical parallels provide insight. 1929, margin trading. 1973, external shock. 2000, tech speculation. 2008, derivatives. 2020, black swan events. Each generation sees its crisis as unique, but the underlying mechanics are remarkably consistent. Optimism leads to risk-taking. Leverage magnifies exposure, triggers expose fragility. Panic accelerates correction. Modern financial architecture amplifies risk and obscures it. Non-bank institutions and complex derivatives create opaque interdependencies. Complexity hides vulnerability. Corporate leverage interacts with household vulnerability. Highly leveraged corporations threaten employment. Market corrections propagate into households through employment losses. Transmission speed exceeds historical precedent due to globalization. A crisis in one sector quickly becomes a systemic event. Currency interdependence further complicates outcomes. Central banks may intervene, but rising debt and concentrated exposure compress reaction time. Confidence, the intangible backbone, becomes the limiting factor. Policy interventions mitigate immediate shocks but expand latent risk. Quantitative easing prevents collapse in the short term but encourages over-leverage. Structural adjustments are postponed, ensuring larger corrections later. Each generation benefits from prior interventions while inheriting amplified risk structures. Every generation faces a crash because human behavior, leverage, systemic opacity, and external shocks repeat across decades. Technology and policy influence scale, but not the cycle. Education, awareness, and preparation can mitigate impact but cannot prevent recurrence. Structural weaknesses persist. No generation is immune. Each will face its own correction. The inevitability of crash is structural, systemic, and psychological. Recognizing this allows for anticipation, not avoidance. Understanding repetition allows society to adapt, prepare, and survive, even as each generation confronts its own inevitable financial reckoning. Memory fades, and the pattern begins again.